Explainer 4, Upstream Inflation. Hi, John Rothfield with Derivative Logic. A river has a source and a mouth. For inflation, that river is the supply chains. The chain usually starts with primary products, interchangeably called raw materials or commodities. We all remember Eddie Murphy trading orange juice futures in the movie Trading Places. Energy, farm and forest products, industrial metals and so-called bulks, which are coal and iron ore, are bought and sold by contract and traded in global markets, both spot and futures. Their prices tend to operate in cycles, such as the prolonged cycle that followed China's 2001 accession to the World Trade Organization. But within those cycles are the various unknown unknowns, the most prominent of these being climate and war. The two popular measures of raw material prices are, number one, the World Bank's Pink Sheet, an exhaustive set of commodity prices going back to the 1960s on a monthly average basis that is handily published shortly after the end of each month by the World Bank. The other is the Goldman Sachs Commodity Price Index, or GSCI, which is a basket of 24 commodities that can be used as a hedge or traded on the Chicago Mercantile Exchange or as an ETF. Now, of course, once these raw materials are purchased and transformed, they get into the supply chains. One useful aggregate proxy for the costs that companies face along their supply chains is recently actually provided by the New York Fed with its monthly Global Supply Chain Pressure Index, or GSCPI. The components of that index include the Baltic Dry, which is an approximation of maritime costs, the Harper Index, which is a proxy for shipping costs, the Bureau of Labor Statistics Air Freight Cost Index, and purchasing managers' data on delivery times, backlog, and stocks. This data is collected for 7 countries or areas that are most prominent in the global trading system and published pretty promptly after the end of a month. The Bureau of Labor Statistics also publishes a companion piece to its Consumer Price Index every month called the PPI, or the Producer Price Index. The PPI actually got a do-over in 2014 to improve its relevance, but it still gets less fanfare from the street. However, it is considered to be a useful proxy for upstream inflation. The PPI uses a 4-stage production flow model, stages 1 to 4, to track how costs move from raw materials to final inputs. These are called intermediate PPIs. Then, when producers are at the point of passing on their products to wholesalers and retailers, the average price at which they do so is called the PPI for final demand. Each of these intermediate and final demand PPIs is published each month. And finally, the PPI even attempts to measure the wholesale and retailer margins in what it calls the Trade Services Index. So how does the PPI inflation rate align with the CPI inflation? In 2022, the Richmond Federal Reserve published a piece with the title, "I Spy with My PPI More High CPI." In the short term, the relationship doesn't do well, but in situations where PPIs, intermediate and final demand PPIs, move well ahead of the CPI, there is a significant risk that eventually the CPI accelerates to catch up. So for a prospective borrowing in markets where actual and expected inflation matter, it pays to be aware not only of current inflation, but that which may be in the pipeline. Please let us know if you have topics which we should cover in our Explainer series.